Hey, good afternoon, everyone. Marty Mazur here, August 14th, 2021, with your weekly macro update. Last week on the update, I made a promise at the end that we would walk through some of the technical analyses together. And I followed up with a look at gold and a look at the stock market overall using the S&P 500 index. Intended, time permitting, to come back and take you through some of the individual positions. Didn't do that yet, still will. There's some interesting developments I think worth sharing to those of you who seem to appreciate the technical analyses. Won't go there this morning, thought about it, but then I think we'd be here longer than I think I'd like to or you'd like me to in one sitting. So again, like last week, I'm just going to focus on our indicators within our index. I will comment on some of the commentary that I've taken in of late, particularly today. This morning and into this afternoon, I made it a point to read some of the latest reports from some of the macro analysts whom I respect the most. I was listening to a gentleman with MI2 Partners, which is a firm that I have a tremendous amount of respect for, its individuals. This gentleman's name is Harry Melandri. And in an interview, Harry was asked about what the market would do, how it would react when the Fed begins to taper the amount of bond purchases that it's doing each month. He reminded us that taper is not selling bonds, which would be a serious tightening. Tapering is just slowing down the amount of bonds and mortgages that it's purchasing each month. He seemed to kind of discount the market impact. I'm on the other side of that opinion. I would say that the market is going to react negatively. I'll be surprised if it doesn't, particularly if it were to happen right now when I see quite a bit of concentration on that bull side of the boat. He could be right. The Fed is certainly trying to telegraph that a lot. The several Fed members who are typically dovish have sounded more hawkish in their commentary of late. So perhaps at the Jackson Hole symposium that's coming up, maybe Chairman Powell will talk about tapering bond purchases. Anyway, Harry made an interesting point, and I actually can sympathize with this. He said there's nothing that the Biden administration would love more than a 10% correction in the stock market while it's trying to pass an absolutely ginormous spending bill. We're getting the bipartisan infrastructure bill, but there's more in infrastructure and a lot of other ambitions that this administration would like to get passed or get going on. What greater opportunity to get everybody on board than what will feel like, relative to what we've experienced late, a real serious correction in the equity markets. So his point is, if indeed the Fed tapered or threatened a tapering and we got a 10% correction, nobody's going to be complaining about that. And actually makes some sense. I witnessed back during the great financial crisis when TARP was introduced, and it was 700 billion or something, which was massive at the time. Congress said no. The market rolled over hard. They reconvened. They rushed to reconvene, and then they passed it lock, stock, and barrel. Right now, for our purposes, we do have a bent toward reflation, toward secular inflation. That's in the resource space with equities, particularly the U.S. equity exposure, being in the regions that are commodity centric in the emerging places. Latin America really is where we're kind of focused now. And then recognizing the undervalue in non-US versus US equities, but then owning a good chunk of gold as well, which would be defensive. But really the ideal trade, if we live in a world where we're going to have some inflation, but we're going to have the suppression of interest rates for the reasons that I keep talking about. We did cut gold just a little bit. It's still right where it was in terms of where it sits in terms of our top positions. But we took a little off, and we took a position, half of the position that we've targeted in AMD, the the semiconductor company. We previously, I think the week before, we added Nokia to our list of 5G plays, and what we did to grab Nokia is we cut AT&T, Verizon, and Viacom, CBS, by a third each to grab some Nokia. Nokia would really be a well-positioned, in our view, 5G component maker. So as you can tell, we're at the margin accumulating some positions that we think make a lot of sense beyond all this in the longer term scheme of things. There's a unique infrastructure technology company that we're doing the work on right now that that we may take a position in the next few days to week or two. So folks, again, the name of the game right now is to certainly, our view, we're a real top-down firm, is to really continue to dig deep into the global macro and just see where there's value and look at it long term and be very patient with it as we go through these gyrations and this volatility. We have, again, a huge spending package on the docket that is going to try to pass via reconciliation, which would, and they have another shot at that, which all they need is a majority, a simple majority. Now, there's a couple Democrats. There's one gentleman in particular who seems to be really pushing back, saying, I'm not signing on for that, $3.5 trillion. Well, we all know how politics work, right? He's got some huge bargaining power for his constituents. So if I were a betting person right now, I would bet, oh, absolutely, it's going to get passed. But this particular individual is going to get something big in it for his hometown, so to speak. I think that would be very bullish for the stock market and very bullish for our trades in particular. So folks, I like where we're positioned right now. I'd say for the next 5 years, where we're going to be the next 5 days, 5 weeks, 5 months, I can't tell you. We are going to continue to actively hedge. So we have a real eye to protecting against something major to the downside. And I'll repeat the mantra that I made very clear going into this year at the firm, and that is, we want to compound at a decent rate. We don't want to lose any money, or we want to mitigate the worst of a big sell-off like we did very successfully last spring. Okay, so with no further ado, that was a lot of ado. The PWA macro index came in at 25 again, so we were flat week over week. Sure are rolling over. That's consistent with a lot of the bears right now. I would argue, though, that we're not in recessionary conditions like others would argue that we are, or we're heading that direction. We've got quite a ways to go before we get bearish on the economy, but that's a noticeable move and something that we need to pay attention to. We actually had 2 of our 48 indicators that actually changed score. The cash freight data actually took a step from positive to neutral, and the sector S&P 500 ratios went from negative to neutral, so they neutralized each other. Okay, so consumer sentiment, we had the conference board, which we already had last week. Their survey basically was flat month over month. The Bloomberg Weekly Consumer Comfort Index actually turned positive after being down for a couple of weeks there. The University of Michigan Sentiment Index, which came out Friday, just absolutely rolled over. Bonds rallied on that. So that was surprising. Expectations were for something a lot higher than that. The Delta variant, I think, is huge in terms of what that did to the sentiment indicator. Inflation expectations are rising as well. Our input that actually, again, went from positive to neutral was the Cass Freight Shipment Index. This is expenditures here, and they actually rolled over a little bit as well. I read through the report, and they really attribute it to supply bottlenecks. They actually talk a lot about lack of supply of truckers going on vacation this type of year, the actual drivers themselves. So they recognize that their index did drop considerably, but they point to these constraints that are coming from the COVID and still bottlenecks and that sort of thing. So they're not viewing it as something that is signaling recession, like they were viewing this roll over here. And we were in that camp as well. We were flagging recession risk here as well. This they're not flagging in that way. Nevertheless, it was enough to move from a positive to a neutral. And then what was positive, this is for the last 30 days. This is major sectors. Over 100 means that it's outperforming the broader market, the S&P 500. Under 100 obviously means it's underperforming. So tech's had a little bit of a rough go of it of late, and it will in an environment where we're reflating or inflating. Tech is what we call the longest duration of the sectors, and it's going to be the most interest rate sensitive. And so it's underperformed a bit of late, while financials, which are very cyclical, which we're pretty bullish on longer term, notable outperformance of the S&P. Consumer discretionary, little bit of an underperformance, but if you look at like materials at 103, energy now of late has outperformed the S&P 500, and then industrials has as well. Now when we were negative, that's consumer staples, utilities, and healthcare, the more defensive industries. So we've gone from clearly negative to neutral. If this keeps up, we'll be positive and we'll gain another point. The JOLTS report, job openings and labor turnover, 10 million job openings right now, of course, which is an all-time record. Not to be too simplistic, but it's hard to argue that things are so bad when employers are so eager to put people to work. Small business optimism index for July came down. The overall score, 99.7, it was expected to come in at 102. When you dig into the weeds a little bit, and we look at the hiring plans, they did come off a bit, still sitting at a very high 27. And then CapEx plans went up a little tick here from 25 to 26. So nothing that would change our opinion yet about prospects based on the signals that we get from the small business space. We also break out, for our purposes, rail and trucking and so forth. Didn't change the score, but worth acknowledging that rail traffic has been rolling over a bit as well. And then again, reading the cash report, they're just talking about bottlenecks, lack of supply. And I'll tell you, my youngest son sent me a text this morning. He was apparently at the grocery store. And let me just look at that again. Attention Save Mart shoppers, in order to serve you, your friends, and neighbors, we are limiting cases of water to 1 case of water per person. We appreciate your understanding. And if you're buying gallons, 2 gallons, right? So not toilet paper yet, but we'd have to conclude that those are concerns over the Delta variant. So I'll stop there. Again, my intent is to, time permitting, take you through what I'm seeing in some of our individual positions. And when I go through the technical look, I typically talk about why we like what we're in from a fundamental perspective as well. So some of that over the next week or so. And next week I'll be back with the macro update and all the morning notes in between. Thanks as always for watching and listening. Hope you have a great weekend. Bye-bye.